Fifth and last technique or method we have is hurdle rate or minimum accepted rate of return, also known as MAR. It's like the required rate of return or triple R, which we mentioned in the last slide. Both of them are used to determine the lowest rate of return that a project should earn back to offset the cost of the investment. But please, before going further, let me talk about two important terms first. First one is break-even point, which is the separation line between profit and loss. This is the point which total cost of an investment and total revenue are equal or even. Means no loss, no profit. As represented here, it's more like a scale, and the profit and loss completely even or equal. Second term would be WACC or weighted average cost of capital. Usually your business doesn't obtain their capital from one source of financing, and WACC is the cost of each type of capital weighted by its proportional percentage of the total capital. What is the meaning of that? Usually when you get your capital, you don't get it from one source. For example, here for simplicity, we are going to use two methods of financing. First one is equity and second one is debt. Don't worry about equity and debt. They have their specific chapter, next chapter in financing option and alternative financing. But for now, equity means getting your money or your capital from stakeholders who would like to invest in your company. And debt, it's known that you go to the bank, get a loan to finance your company or your project. And WACC is the cost of each type of financing option you choose, multiplying by their percentage of overall capital. At the end, you will get a percentage of your WACC. For example, let's say it's 11%. If you have a WACC of 11% and your capital is $1,000 and the return of 25% while you having a WACC of 11%, that makes your profit only 14%. Why is that? Simply you have 100K. You invested this 100K in a project, you get back 25%. This is the return, not the profit. So out of this 25%, 11 should go just to cover the expenses of collecting your capital, leaving you with 14% profit. In other words, you can say that with each $1 the company spent, you get 14 cents as a profit, not 25 cents. Due to the WACC value, the higher the WACC due to the WACC value, the higher the WACC is the less company profit. And in case WACC is more than return, that means the company is losing money. And finally, if the WACC equal profit, that means you reach the break-even point where there is no profit and no loss. Now, since we explained the two terms, let's get back to our main topic, hurdle rate. When investors or company management have a meeting to discuss an opportunity, they sit down and ask a very simple question. What is the minimum rate of return we can accept out of this opportunity? To make it short, this rate is known as the hurdle rate. So the question can be, what is the hurdle rate we can accept out of this opportunity? This rate is not estimated roughly. Usually the opportunity WACC and risk level get involved in the decision making. And after that, hurdle rate is set to a certain value. And if the expected return on the proposed investment is below the hurdle rate, then this investment is not acceptable, and vice versa. And of course, logically, projects with higher risk get higher hurdle rates as a safe margin during project execution. Let's move to an example. Your business is going for buying a new machine for their assembly line, and the planning team estimated the expected increase in profit or in return due to this new machine would be a 9%. Their argument, this increase going to be because of this machine will use less energy, work faster, or even both. And they also assume the risk of 4%. This risk can be not selling the extra product this machine produced, and your WACC for your capital is 6%. First thing, they are going to add this 6% to 4%, the risk plus WACC together, and this is going to be at 10%, and this is the hurdle rate. And since the expected return is 9% less than the hurdle rate, then that means buying this machine won't be profitable and different alternatives should be considered. Because in other words, on much simpler word, if you invested on something that expected to give you a 9% a profit, but you have a 10% of risk and just a WACC just to cover your capital expenses. Even if you achieved the expected return, it's still not going to be a profitable. Another use for hurdle rate is to be used with NPV calculation. Remember the NPV calculation, we simply have our investment with minus, we sum it with each future value of expected future profit, but it's reduced or discounted to the present value using a specific discount rate, which is here represented with small r. Hurdle rate can be explained to replace this r or use it as our discount rate. And of course, the same procedure to be followed. If you have a positive NPV, this is a sign of profitability. It's a negative, then this is a loss. And if you have two opportunities, both of them have a positive NPV, then you have to go to with the one with higher positive NPV. That concludes the 5 techniques, and in the next chapter we are going to discuss financing option, and what is known as alternative financing options. Thank you very much and see you next chapter.